Hello, it's Jonathan Wellham of ROCKLINC Investment Partners, and it's December the 9th, 2021. And I can't believe it, we're at the end of another year. So we're looking forward to our latest addition to our Webcast sessions. So let's just jump right into it. We've called this Focus on Value. And that's because we think that there's a lot of overpriced securities in the market, and we need to be very careful. Now, in terms of the presentation, this is the outline of the presentation, a quick view of our business, our investment philosophy, investment challenges, market challenges, along with performance summary. And then Andrew and Jesse are going to speak to a couple of very important issues. Andrew's going to speak about supply chain disruptions and how we are, looking at companies and trying to do our best in the midst of some of these very important disruptions that are causing problems with businesses. And then Jesse's going to speak about Gold Royalty Corporation, which is a new holding. It's a company that bought one of our existing holdings, Abitibi Royalties, and just going to really speak to that transaction and what that means for us. Okay, let's jump right into it. In terms of ROCKLINC, this is just an overview slide. We're managing pretty close to $250 million now, $250 million, a little over 210 households. And again, as all our clients know, we focus on customized portfolios of exceptional businesses, and we try to look at the market and use an interdisciplinary approach. Our investment philosophy: buy excellent companies, focus our attention and your investments in a limited number of companies so we don't over-diversify, and then we try to compound on a tax-deferred basis by holding those companies for reasonably long periods of time. And then we are spending a lot of time with, what are these companies valued at? So we really want to understand, the valuation and buy them with a margin of safety. That's very difficult in this market as we've seen asset prices go up. And then we want to understand the economic backdrop, which I'll speak to today in terms of some of the slides, what's going on and what are the things that are concerning us. In terms of investment challenges, as we continue to tell you, and these challenges are not going away, we've got global debt levels that, believe it or not, exceed $300 trillion. 8 years ago, that number was around 220. So we've seen like an $80 trillion increase just in the last 8 years. That $80 trillion is approximately what the global total value of goods and services produced in any year, global GDP they would call that. We've actually increased debt in the last 8 years equal to the total value of all goods and services produced in the global economy. It's phenomenal. It's not a good thing. Second, unfunded government promises and expansion of government in the overall economy just continues. I don't have to tell you that. I'll come back to that in a second. Demographics, the aging population, family formations have plummeted, especially with COVID, and birth rates are just collapsing. And that means that the future is not great without family formations and children. In fact, you don't have a future if that's the case. Monetary policies continue to be just ridiculous with the printing of money and liquidity. They're talking about pulling that back. In Canada, we've pulled some of that back, but it's still pretty aggressive around the world. And as you know, we have repressed interest rates. That means interest rates are very, very low, unusually low. In fact, if you think about it, interest rates at 2%, inflation at 5% plus, I'd suggest inflation is higher than that. We'll come back to that also in a few moments. That means your negative interest rate, your negative real interest rate is probably a good 3%, if not larger. So that means you can, inflation is growing at 5, you're only paying 2, you got a spread there, a negative spread of 3%. That is not healthy. It's not sustainable. And we are very concerned about that in the current market. And then I'm going to just again talk about these lockdown mandate folly, whether it's actual lockdowns, whether it's all these vaccination mandates and so forth. These are all very much indicative of government overreach, and they do and will have long-term economic issues with in terms of challenges. It means really at the end of the day lower economic growth. So let's just talk a little bit about these sort of lockdowns and mandate folly. Hopefully we don't see a lockdown in the next little while, but certainly the mandates are hurting some businesses and interfering with commerce. And so let me just go through these points quickly. And all of these points really direct us in one direction. That means government overreach, government involvement in the economy means lower economic growth. And with inflation, that means really we're entering a period where we could see a stagflation, where you get very little growth but a lot of inflation. This is not healthy, and it's not going to be a pretty market, and we have to be very careful as equity investors. So why do we say that? First of all, you have the undermining of many small businesses, which are the engine of growth. When you hurt the economy like we've seen over the last almost 2 years, a lot of small businesses are under a lot of pressure. These are the engines of growth, though. That's where the most of the employment is. That's where a lot of the economic growth comes from, the entrepreneurial spirit. So that's not great for economic growth. This whole state intrusion in the economy, regulations, more regulations, and more regulations throttle economic growth. Massive increase in sovereign debt. I've got a couple of charts I'll point to that. I mean, governments have gone just absolutely crazy over the last 2 years in terms of how much debt they've taken on, how much money they've printed. That also acts as an impediment at long-term economic growth. Then pending increases in taxes. There isn't a government in this world that isn't interested in increasing taxes, and this is a big problem. We're going to see, I'm sure of that, in the new year with our Liberal NDP coalition in Canada. You're certainly hearing about it in the United States with President Biden, if he can pull off tax increases. That, again, will stifle economic growth, build government to a larger size, and this is, again, not healthy for economic vitality, if you will. Loss of freedoms and liberties. We see that all around us. But if you don't have freedoms and liberties, you don't have an entrepreneurial, fast-growing economy. Negative impact on mental and physical health. We've seen that over the last couple of years. Serious issues here. Negative impact on children, their education, their socialization. Devastating impact in some cases on young children, what we've seen in the school system. Increase in domestic breakdowns, lack of family formation, increase in substance abuse, substantial increase in overdoses. The U.S. has seen a 50% increase in overdoses and suicides just in the last 3 to 4 years, about a 25 to 30% just since COVID started. And these are large numbers. And it shows that there's really, really a lot of underlying mental health and spiritual and other physical issues, health issues in the economy, and this is not great. And then substantial backlog in medical practices and procedures, which we're seeing, especially in Canada. And this is leading to, again, if you're not doing these screenings for cancer and other diseases, then that leads to excess deaths, which is what we're seeing if you're actually tracking some of this in a number of the countries. And so this is a concerning trend. These are not good things. These are things that the government just does not seem to be overly concerned about, but they should be. And we certainly are as investors as we watch this longer-term impact on our economy and our social fabric. So market challenges. Inflation pressures have arrived. That shouldn't really surprise us given what we've been seeing since 2008, 2009, and which was only accelerated as we entered into 2020 with the lockdowns and the response here to COVID. So here's what we're seeing. Market valuations are very, very high. And so we expect a repricing to take place in the market, and we want to try to avoid the places where prices are the highest and cannot be justified based upon the economics. So we're very concerned, and we're being very selective in what we're buying. Second, central banks continue to print money. They call it monetizing the debt. There's no really sophisticated way to say it other than they're just printing money. The United States still $120 billion dollars a month. They're talking about bringing that down slowly. We don't think that central banks can actually taper, if you will, pull down the printing of money and increase interest rates without bringing on a serious recession, and maybe even worse. And so we're very skeptical of that, but we're very concerned that if we're equity investors, we need to be in great businesses trading at very attractive prices where we'll be buffered, if you will, and have some hedges against larger downtakes in the marketplace, and especially in areas that are expensive. Unprecedented increase in debt levels continues. Rising concerns over the dramatic increase in inflation, asset prices, and food costs. You've seen this. We're now seeing the highest level of inflation in 30 years. In fact, I can even remember going back to the 70s, what it was like to see 8, 9, 10, 11, 12% increases per year. And, the government stats show 5%, but I don't think there's any of us who look at the housing market, look at food, look at rent, look at all sorts of different areas and aren't looking at inflation that is probably double that. I mean, housing prices alone have increased about 30% since March of 2020, since the onset of COVID. Structural deficits, and that means the governments are addicted to debt, addicted to running deficits, addicted to not balancing their budget. This, again, cannot go on indefinitely. That's the whole point. Citizens are oblivious to the precarious financial position of the global economy. When you talk to people, it's quite surprising. They don't seem to be alert to the global pressures and all of the debt out there. So, again, we're very focused on this. We're trying to protect our investors, protect the capital by buying great companies that shouldn't get bounced around as much as this pans itself out. And then economists just keep dreaming up more silly theories. I mean, economists generally have a lot of silly theories, and I studied a lot of economics, have degrees in finance and economics, but many of their theories are completely, abstractions from reality, and they don't work. They never have worked, and yet they seem to go back to them all the time. And one of the greatest sort of abstractions from reality is this modern monetary theory, MMT, which means that you can just continue to print money, and as long as you monitor it somewhat, you can get away with printing large sums of money. And no, you can't. It won't work. You are going to ultimately depreciate the value of your currency, and you're going to put the prices up, and you're going to see inflation. So this just a couple of charts just to illustrate, like we've mentioned these points. Why are we concerned? If you look at this chart, government debt to GDP, this would be sovereign debt. So this would include the federal and provincial governments or state governments. You can see that Canada and the United States now are well above the average in the world. In fact, the United States, with the reserve currency of the world, is actually tracking at 133% debt to GDP. You start getting above 80 and 90%, it becomes very difficult to dial this back without problems. Canada has just skyrocketed our debt to GDP, and we're now sitting at 117 and growing very quickly. We were just a few years ago, probably 60, 70. It's just the increase has been dramatic, to say the least. And again, it's not sustainable. The Canadian government debt, you can just see here, if you go back to the financial crisis, we were less than $1 trillion. And this is the combined federal provincial. Now we've blasted well over $2 trillion. So you can see this kind of increase, and it's the last little while it's become exponential. In other words, it's growing at a compounding rate. And that's, again, because of particularly the federal government's just abuse of spending, and I'll come back to that in a second. The Bank of Canada, if you look at this chart, what it shows you is from 2019 up until COVID hit in March. The government did these lockdowns and basically crushed large portions of the private sector. And what happened then is the Bank of Canada just printed money. So we went from, over a little over $100 billion in, currency, and you can see that jumped up to over $500 billion. I mean, look at that. It went just straight up. And they were just pumping that money into the system in order to keep it stable as they locked down private enterprise, basically. Well, that money's all out there. That money is going to, slosh through the system as velocity of money and turnover picks up, and as businesses start to open up in the future, then of course we're going to see inflation. Of course we're going to see the bidding up of prices. This should not surprise us. This is economics 101. So the Federal Reserve, this just shows the same chart in terms of the Federal Reserve balance sheet. And the Federal Reserve is important, I think, as most investors know, because that's the central bank of the United States, and it represents the reserve currency of the world. And you can see how that's been growing also since, go back to 2006, 2007, how it jumped up with the financial crisis, and then how it just went straight up again in the situation with COVID and lockdowns. And so you've gone from less than $1 trillion, $800 billion back before the financial crisis in 2006, 2007, and we blasted through $8 trillion. Think of all that money being put into the system. It's really quite shocking. And so that's left us with high valuations. This is a chart, again, that shows this is the S&P 500 index, which is a very good compilation of global businesses based in the United States, largely. And you can see that the valuations are trading at quite high levels. And so it doesn't mean all stocks are overvalued, but it means there are a large number that are, and we need to be very careful. That's the point. We need to be very careful in how we approach the marketplace, and we need to pay attention to value. Now, our marketing position, there's lots of things I could say, but I've just summarized it in 4 points very quickly. We pay attention to valuations and the balance sheet strength of companies. We have to. We invest in harder assets. What I mean there are infrastructure, real estate, very tangible businesses. They tend to be better inflation hedges. Keep a significant weighting in precious metals through leading royalty companies. And Jesse's going to talk in a few moments about one of those companies, Gold Royalty Corp. We, again, buy this because it's a hedge. Interestingly enough, gold and silver have been quite weak. And that provides us with a great opportunity, actually. It's wonderful to have certain sectors that are actually undervalued that we can pick away on. And so we continue to be very careful and try to be as skillful in that sector by picking up more shares in some of the leading companies. And then we invest in essential industries with above average growth. Examples include technology, healthcare, consumer staples, asset management businesses, and so forth. So we're doing our best to take advantage and continue to build great portfolios at attractive prices that can withstand the pressures that are going to be coming down the pipe here in a lower growth environment. Our performance summary here, this is across our whole business, our ROCKLINC business, which is about 70% in equities, 30% bonds, short-term investments. And you can see those numbers there over the last year, about 5.6%. This is after all expenses and fees. And over the last 5 years, we've been compounding at over 10% a year in some of the highest quality sort of portfolios that we could possibly build. And over the last 10 years, over 8% per year. And so we're chugging along at a nice rate, protecting capital. And in particular, I think we're incredibly well positioned if there is trouble in the market. And we think that trouble will come at some point, and we need to be there and in the kind of companies and positions before that trouble hits. So I'm going to hand it over to Jesse and to Andrew. Andrew's going to talk about supply chain disruptions, and then Andrew's going to pick it up and talk about Gold Royalty Corp. And these are a couple of really interesting areas, and I know you'll find both of their discussions very, very helpful. Thank you very much.
Over the past number of weeks or months, you may have heard the word supply chain disruption in the news headlines. Now, whether it's in the grocery store or your recent shopping Christmas visit, it won't take you too long to figure out that the prices have been rising across many categories. Now, what is causing these challenges to the overall supply chain system? Why has there been shortages, and why has there been such delays in some of the products that you've been ordering? Well, in this presentation, I'll walk through some of the factors at play that have led to the global supply chain disruption, the implications of this disruption, and I will then highlight a few of the companies that we currently are investing in and how they have been impacted by the supply chain disruption environment. Now, collectively, there are a number of dynamic factors that are intertwined with one another that has been putting pressure on the global supply chain system. Now, from your Economics 101 class, we've learned the concepts of supply and demand. Whenever one is greater than the other, there is a disequilibrium. And so both factors are important in understanding what is going on within the economy. So before talking about the supply side, I want to first touch on the demand side. Now, on the demand side, we have consumers, and household savings in both Canada and the US have been much higher than since the pre-pandemic levels. According to the US Commerce Department, households have saved an aggregate of $1.6 trillion in savings. Now, this has been attributed to many different factors. One, specifically has been the many rounds of government stimulus that have been benefiting both Canadian and U.S. Citizens. We also have people who have been sheltered at home, not having to pay for certain regular expenses that they would have to pay when they have to go to work, or whether it be some food costs to be able to save. And so households have more disposable income. that have been increasing at a relatively faster rate than actually the consumption, which is leading to higher net savings. Now, similarly in Canada, household savings rate have increased to 14.2% in the second quarter of this year, from 13% in the first quarter of this year, according to Statistics Canada. Now, this has been helping drive the increased demand for imported goods. Now, on the U.S. side, U.S. consumer demand has been quite strong, with consumers spending $640 billion in retail stores and restaurants, compared to $520 billion in October of last year. So as you can see, there is a robust consumer demand for goods, ultimately from higher savings, from being locked down at home. So people are spending money renovating homes, buying goods at an accelerated pace. So this strong demand has, and as a result, has been placing pressure on the supply chain system. So now let's turn to the supply side. The supply side has been driven as a result of the demand side. So there's been strong consumer demand, which has led to higher demand for raw materials. So these are the things that are used in the production process for the regular manufactured goods that we get to benefit. So some of these commodities have increased actually across the board, which hasn't been seen since the financial crisis. So we have lumber, iron ore, copper have hit record prices this year, while corn, soybean, and wheat have hit 8-year highs from strong demand as restrictions have eased. And so this ultimately has increased the cost of inputs into manufacturing goods, and some of these manufacturers have passed on these costs over to consumers. So this is one factor as to why you have been starting to see your cost increase. Manufacturers and retailers have also faced higher costs from transportation, such as ports, shipping, and trucking. So, for example, on the port side, two major ports at the center of the supply chain disruption are the ports in Los Angeles and Long Beach, which are the two major ports in the U.S. They're approximately 40% of imported goods that enter into the U.S. The adjacent ports in Los Angeles and Long Beach are the 9th biggest container port complexes in the world. Now, ships have been unable to dock right away and unload their containers and had to wait for as many as a few weeks in the water. And so one of the reasons driving this bottleneck has been a shortage of a equipment called the chassis, which is a trailer used to transport containers from the dockside to a terminal or warehouse that could be as far as 50 miles away. Now, the large amount of imports from high consumer demand has also weighed on the labor side of a warehouse, which has been having shortages in labor. And so you have this high demand for these goods and a labor shortage in the warehousing, leading to slower turnaround of these chases of these new cargo. And ultimately, you're not unable to have your containers being transported directly to a warehouse. And so you have this kind of this domino effect, you have all these ships coming into ports, and you have this one siphon trying to get through and unable to. So you have this backlog of all these different container cargoes waiting to be unloaded. So as a result, you have this delay in inventory being transported to its destination. COVID has definitely played an impact on this, as well as the number of individuals, particularly in non-North American, are impacted with COVID. This leads to less workers being able to provide services, particularly in the manufacturing and the warehousing. But also, too, there are the quarantining, the different restrictions that are putting in place with testing, that's also continually perpetuating or exacerbating the delay in turnaround time of goods being shipped and transported. So many factors at play, as you can imagine. And also to add on to that too is the trucking industry. Now the trucking industry, which is kind of like the last mile from the manufacturing, the warehousing into the retail stores, that this industry too has been facing great pressure as well. There's a shortage of truckers that has been around for a while. According to the American Trucking Association, there's a lack of approximately 80,000 truck drivers. In Canada, there has been a mandate for truck drivers to be vaccinated by January 15th of 2022. And so you could have potentially a 20% of the 120,000 Canadian truck drivers that choose not to be vaccinated. As you take what's already a shortage in labor within the trucking industry, and you're putting on these mandates that even further reduce your labor supply. And then, as you can imagine, it's already been exacerbated with this labor shortages. You're just going to have continuing perpetual delays within products because there's not enough truck drivers to send out. Now, I've already mentioned a bit about COVID-19, some social distancing protocols, the testing that does lead to the slowdown in the pace of workers across the supply chain. And then also, too, is the labor. Now, on the labor side, job openings have been higher than pre-pandemic levels, which was 7.5 million job openings in November of 2018. Now, job openings have been particularly pronounced in the shipping, warehousing, consumer retail, leisure, hospitality, transportation, and the manufacturing side, which have, as I've already mentioned, contributed to the supply chain disruption that slowed down the delivery of products and services. Now, with a reduced labor pool, companies are essentially competing for the same number of employees, causing these companies to have to raise wages, add in incentives such as signing bonuses to entice workers to work in these industries. And so this has ultimately led to further higher costs being placed on companies. So with all these factors in play, with higher commodity raw material costs, with transportation and COVID testing and those protocols, and then and then adding on the labor side, this is just continuing to increase the cost of manufacturing. And as a result, these costs are being passed on to consumers like you and I. And we see that across the board within groceries, within many different goods that we purchase. Companies that don't have contracts that allow for limits and price increases will have their margins being squeezed. And so as a result of this, companies are facing the pressure of lower profits. So an example, Unilever, which is a competitor of a company that we invest in, Nestle, has been raising prices at a fast rate, not seen since 2012, due to higher raw material costs, such as palm oil, soybean oil, crude oil, and shipping costs, which have been higher by 4.1%. Food prices have also increased due to higher labor, transport, and ingredient costs. U.S. inflation has hit a 31-year high in October as consumer prices, which increased 6.2%. The CPI, Consumer Price Index, which excludes food and energy categories, increased 4.6%. So we're seeing rapid inflation as a result of the supply chain. And, there's many pundits that will say, oh, this is temporary. You'll hear the word transient. But we're hearing from companies that this is not just a 2021 issue. This is going to be something that's going to continue into 2022 and potentially 2023. And so prices are going to continue to increase into the foreseeable future. And so this isn't something short term that many people might think to be. Now, with that in mind, how does this impact our investment portfolio? How does this impact you as investors? Well, fortunately, we have a number of companies that we invest on your behalf that have been quite resilient in managing the supply chain disruption. And so there's just a handful of these companies, but the companies that are specifically selected are particularly impacted by supply chain disruption, particularly in the retail side. And so I wanted to focus on these companies and walk through some of the things that they are doing to either divert from being impacted or mitigating or dampening the impact. And so the companies, first off, is Amazon. Amazon, which is a large holding, has deployed a number of different sources to transport its goods, from chartering ships, flying packages on over 70 of its Amazon air cargo jets. It's driving its packages through its Amazon branded vans. One of the reasons for Amazon's success is that they've focused their business on the long term rather than worrying about their business quarter by quarter. And so they've been able to think and build their business by thinking out 5 to 10 years in advance. So they have already been planning and preparing for situations like these 5 years, maybe even 10 years in advance. So long before this major supply chain problem, Amazon has already been chartering private cargo ships and acquiring their own containers and leasing planes. These early investments have enabled Amazon to bypass port congestion by chartering their own private cargo vessels. Last year, when airlines were facing heavy travel restrictions, Amazon saw an opportunity to fill that empty space with cargo packages. And so they were able to transport their goods on empty planes through these partnerships that they were able to develop. And so now they're able to benefit and leverage that now as well. The labor market in the distribution and warehousing has been particularly tight, as many retailers compete for the same employees. So Amazon too has experienced some of that squeeze. They have hired 150,000 US seasonal workers to pick, pack, and ship items. And to entice these workers, they have had to add in incentives. So they've raised up the price per hour to $18 per hour for employees. They have also added bonuses, one-time sign-on bonuses of up to $3,000. And so this has led to cost of Amazon for about projected $4 billion for the last quarter of this year. And so Amazon has had some impact on their business on the cost side, but because Amazon is a low-cost retailer, they're able to distribute these costs across its business. And so they have been able to cushion these price increases fairly well relatively to other smaller and competitive retailers. Another company that we invest in is Church & Dwight, and we've talked about this through newsletters or through our presentation. So Church & Dwight, consumer staple company, maker of Arm & Hammer baking soda, OxyClean, Batiste dry shampoo. They have had robust demand for many of its products. In the last quarter, Church & Dwight increased consumption across 12 of its 16 categories in the U.S., and 5 of those have had double-digit consumption growth. Now, Church & Dwight has experienced supply chain disruption, which has affected its supply labor and third-party manufacturers. It's also had higher costs, commodities, distribution and transportation costs. But management has been able to pass on these costs to its customers by raising prices on approximately 50% of its portfolio, with plans to raise another 30% next year. Management has mentioned that volume elasticity, which is the relationship between pricing and the demand for products. So as price increases, we'll oftentimes see a lower demand for its products. The elasticity for Church & Dwight has been quite robust, meaning that as it raises its price, it hasn't seen a significant drop-off in demand and volumes that it initially anticipated. So we are seeing that consumers still continue to buy these important consumer staple goods despite price increases. The next company is Nestle. So Nestle is the world's largest food and beverage company in over 180 countries. They have noted higher cost inflation from supply chain disruption. Input, energy, and freight costs have been rising higher. But similar to Church & Dwight, Nestle has been able to respond to these higher prices by steadily increasing prices over the past 4 quarters. Now, in the first 9 months of this year, Nestle's pricing has increased 1.6%, which is actually the highest level for the past 6 years. Nestle anticipates that it will be able to pass these costs on to consumers for the remainder of 2021 and 2022. So you might see your Haagen-Dazs ice cream increase a little bit, and so you'll know why. They've tackled these cost inflations through cost management, leveraging product mix, and other revenue management tools to mitigate these inflationary costs and strengthen its overall profit margins. Now, despite this, we're still seeing robust volume growth, which is what is important, a driver of organic growth rather than price increases, which is what you like to see when looking at revenue growth. 2 more companies to go. Thermo Fisher, we mentioned this on a previous webcast. Global provider, scientific laboratory instruments, equipment, and solutions. They've been able to weather the supply chain disruption very well. And the reason for that has been their efficiency program called Practical Process Improvement Business System, or PPI for short, which has helped the company produce a culture of constantly improving productivity and quality of service and products across all of its businesses. Now they focus on their regional manufacturing. They have a broad-based distribution capacity across multiple geographies, which has helped them to be able to lower the cost and share their services across many of their businesses. On its last earnings call, Thermo mentioned that the supply chain disruption did not actually have any material impact on its business. So you have a global business not being impacted by the supply chain disruption because they've been able to navigate it quite well. And then lastly, a company that's actually benefited from supply chain bottlenecks has been Brookfield Infrastructure Partner, which is one of the largest holdings that we have across our client base. Some companies have actually benefited from supply chain bottlenecks, like Brookfield. Brookfield operates logistics infrastructure and has benefited from high demand for its infrastructure. And so during periods of high demand, Brookfield is able to realize higher tariffs as its customers compete for capacity. And also, it has benefited from increased demand for its storage business. And so with these tighter supply chain challenges, Brookfield actually stands to benefit as it's able to actually increase the pricing of its infrastructure. So overall, we are keeping on top of what is going on with the supply chain environment within the economy, but also very focused on how this is impacting our current client portfolio. And so very astutely, these companies have been able to manage the supply chain challenges relatively well. And this will continue to impact many different industries and will be a challenge across the board for the next number of months. No one's able to put a fingerprint of when this is going to end. And so we might continue to see higher prices across the board. But companies who are able to bypass these prices onto consumers are able to maintain their profit margins and still reap a good return for their shareholders, which is what we like as investors. And so we'll continue to keep on top of our companies, and we'll be looking for new companies that will also be able to either mitigate or benefit from supply chain issues going forward. So I'm now going to turn the call over to Jesse, who will be talking about Gold Royalty.
Thanks, Andrew. Today I'm going to be talking about Gold Royalty Corp. It's a newer holding across client accounts, but we're quite familiar with the underlying assets as we've been invested in them for quite some time. Gold Royalty Corp is a gold-focused royalty business with over 191 royalties on mines, exploration projects, land parcels, predominantly located in North America with some exposure in Southern America, specifically Brazil. Gold Royalty dominates the sub-1 billion market cap sector and has been buying up several players in that space, solidifying its market position. Gold Corp has been spun out of gold mining last year. Gold mining and its chairman, Admir Adnani, he has been buying up royalties on early exploration projects, mines, for many, many years, and he's been buying them at the lows of the gold price cycle. So we've been buying these great assets for cents on the dollar. It's these great assets and royalties that are now spun out into Gold Royalty Corp. Like I mentioned, Gold Royalty Corp has been acquiring some other peers in its space, and one specifically is Abitibi Royalties. We've been long-term investors in Abitibi for some time. The premier royalty of Abitibi is the royalty on the Malartic mine in northern Quebec. It's operated by Yamana Gold and Agnico Eagle. It's Canada's largest operating mine and produces around 600,000 ounces per year. With the acquisition of Abitibi by Gold Royalty, the mark-to-market value of this great asset has now been realized, and we continue to have exposure to this great asset because Gold Royalty has paid for Abitibi in shares. So now we're shareholders in Gold Royalty Corp. The combined entity, as you see there in that graphic, is quite substantial. You have 191 royalties across a diverse array of types of projects in different jurisdictions with increased diversity in the number of operators as well. So you go from Abitibi, whose flagship royalty on the Malartic mine has now, you now get a basket of great royalties across geographies, across operators, and by different types of projects too. For a sense of scale of Canada's largest mine, here's a picture of the Malartic mine in northern Quebec. It's nudging up against the town of Val-d'Or. The open pit mine is reaching the end of its life, and soon the operators, Yamana Gold and Agnico Eagle, they will be moving to underground mining, and this is going to extend the life of the mine by several decades. So this is a great asset. It's currently cash flowing, has been for many years in terms of the royalties on the project, and will continue for many, many years to come. A couple of reasons why we like the merger or the acquisition of Abitibi by Gold Royalty is now you have venerable management. The former CEO of Abitibi, Ian Ball, we've known for many years, met him many times. He's a very capable young CEO, and now he's on the board of Gold Royalty, and the CEO of Gold Royalty is David Garofalo. He's a former CEO of Gold Corp before it merged with Newmont, now one of the world's largest miners. He's also the former CFO of Agnico Eagle. The board is comprised of many former CEOs of miners and some finance individuals that have been involved in the metals and mining space for their whole career. So with such an experienced board and with their great connections, you have access to basically any major CEO in the mining industry globally. And this gives Gold Royalty access to deals and to bring several projects forward. So having a great mining company and royalty company headed up by experienced CEOs and board members that seek to move many of the projects forward is fantastic. The second reason why we like the acquisition is that it unlocks the value of Abitibi. Abitibi's royalty on the Malartic mine is very long duration in nature, so its cash flows are stretching out far into the future. And there is an immediate mark-to-market of this asset, which was largely underappreciated by the market. So now you have unlocking of value immediately, and now you hold shares of Gold Royalty. So you don't give up any of that great aspects of that project, either in terms of gold price appreciation or in terms of additional discoveries found at the Malartic mine or the surrounding region, which is very probable given the high quality nature of the mine. And then lastly, you have the improved diversification of now what is Gold Royalty Corp. A huge basket of royalties, six cash flowing, 7 on assets in development, and then many more on early exploration projects or those in feasibility stage. So you have improved diversification in terms of geography, in terms of the operator, and then in terms of the type of project. You have several cash flowing, several still in early exploration. And the partners, in terms of the operators, are very high quality. I've mentioned Eagle, Yamana, which is one of Canada's largest miners, and then you have several in the States, specifically in Nevada, which is one of the world's premier jurisdictions for mining, with Wallbridge Gold down there. So there's improved diversification on many levels, and that's another aspect of the acquisition that we like. So we continue to hold Gold Corp and selectively add it. It's used in portfolios in conjunction with several of our other very high quality miners and royalty and streaming businesses such as Franco-Nevada, Wheaton Precious Metals, Sandstorm, Royal Gold. And Gold Corp is now going to be added to those ranks. So you may see it in your client accounts, and if you don't, you hold one of the other great, fantastic operators, royalty and streaming businesses in its place. So this is just a recap on the acquisition of Gold Corp, of our long-term holding Abitibi, which was nice to get that premium, that mark-to-market adjustment on the value of that asset there. And we look forward to holding Gold Corp or Gold Royalty Corp far into the future, and very excited to see the prospects, the bringing to bear of many of the early exploration projects. I'll hand it back over to Jonathan to finish off the webinar.
Thank you very much, Andrew and Jesse, for those excellent presentations and overviews on the supply chain disruptions and how the businesses we own are taking advantage of that and how they're responding to a very unique situation. And then also Jesse speaking to Gold Royalty Corporation and that really unique merger with Abitibi Royalties and also Golden Valley, which we owned in our portfolios. And now we're very, very proud long-term owners. We're looking at the long-term for Gold Royalty Corporation. So with that, the webcast is over, and we appreciate your support for 2021. We're looking forward to 2022, and I want to wish each of you a Merry, Merry Christmas and a wonderful holiday season with your family and friends. And most importantly, remember the true meaning of Christmas, that God so loved the world that he sent his only begotten Son into the world, that we, through faith in him, might have everlasting life. It is a message of hope in a world where there's not as much hope as we would like. But in the message of Christmas, we see hope and lasting hope and truth for all eternity. So may God bless each of you, and may you have a wonderful Christmas and holiday season. We'll see you in 2022. Bye now.